Hey guys, we are back with episode 2 of the financial statement analysis series, the series where we go through the 3 major financial statements and analyze them in depth. Of course, if you haven't seen episode 1 where we analyzed the income statement, I suggest that you go check that out first. But in this episode, we're going to be having a look at the balance sheet. And similarly to last episode, we're going to go through the major components of the balance sheet, what's important to me as an investor. And then, of course, we're going to go through what we're looking for in the balance sheet as investors, what's important to us, and what are the positive and negative signs of things that we can identify within the balance sheet. So that's what we're going to get into in today's video. If you do enjoy this video, make sure you leave a like and let me know your thoughts in the comment section below. But for now, guys, let's jump into it. All right, we are back with episode 2. And of course, last week we had a look at the income statement, and we're just going to scroll down and continue on. And today, of course, we're looking at the balance sheet. Now, the balance sheet tells us what? It tells us it's basically a snapshot of the company, and it tells us what a company owns and what a company owes at a particular point in time. So with the income statement, it was over a particular period. So it was the year until September 29. So it was a particular 12-month period. For the balance sheet, it's a little bit different. So it's just a snapshot at a point in time. So we're not looking at how their assets changed over time. We're just looking at what their assets are at this point in time, at September 29, 2018. And they've got the 2017 numbers here, so we can see how they have changed since 2017. But essentially, it's what they own, which is their assets, and what they owe, which is their liabilities. That's basically what the the balance sheet is. And we're going to go into the major components and what is important to us as investors. So the balance sheet has 3 major components. There's the assets, there's the liabilities, and there's the shareholders' equity. And it's called a balance sheet because it balances the assets. So total assets for Apple is 365 billion. That is equal to the liabilities plus shareholder equity. And you can see that liabilities are here, equity is here, and if you add those two together, 258 plus 107, that equals 365 billion, which is the exact same amount as the assets. And I'll sort of explain how this makes sense. So these assets, they have to be paid for in some way. So somehow you've got to pay for your buildings, somehow you've got to pay for the securities. So it's just a matter of where the money came from to pay for these assets. So if a company took on debt to buy these assets, then that's going to be a liability. And that's going to come under their liabilities here. You can see they've got long-term debt, they've got short-term debt, there's all these other things that we'll get into in a little bit, but it could be funded by debt. The other way that these assets could be paid for is by the shareholders, by the equity, by the money owned by the shareholders. And hopefully that makes sense to you, that the money's got to come from somewhere. If they're going to buy an asset, either the company uses their cash and they buy it, the owners buy it, or they take on more debt and that's how they buy it. But either way, it has to come from somewhere, and it's got to come from either someone who they're going to owe in the future, so they take on debt and then they have to pay it back, or they just own it and they reduce one asset. Usually what they'll do is they'll reduce their cash and they'll put the cash into inventory. They'll buy inventory and they'll just shuffle it around. So those are the 3 major components, and we'll go through each of them because there is a lot to talk about in each of these. The first one is assets, of course, and assets are what the company owns and will provide benefit to the company in the future. So for example, inventory, that will provide a benefit in the future because it'll produce revenue when it's sold, right? So when this inventory is sold, it's going to provide benefit. And similarly, cash provides a benefit because it's cash. It can be used, it can be deployed. So that's a benefit. We've got marketable securities, they bring a return in, so that's also an asset. It's likely going to provide benefit to the company. Now these assets are broken down into current and non-current assets, or also known as short-term assets and long-term assets. And essentially we'll start with short-term assets or current assets. Current assets are those that will be converted into cash within 12 months. So they're not cash now, or they might be, but they're something, and they're going to be converted into cash within 12 months. So for example, under inventories here, this inventories, they've got 4 billion of inventory. That will be converted to cash within 12 months, so it's a current asset. So it's going to be sold and turned into cash. We've got cash as a short-term asset, of course, because it's already cash, which makes sense. We've got marketable securities, which is going to be converted into cash within the next 12 months. So that makes sense as well. And we've got what's called accounts receivable. And this is money that is owed to the company. So it's an asset because someone else owes us that money. So that money is going to be coming in within the next 12 months. So it's a current asset. Then we've got what are called non-current assets or long-term assets. And these are assets which are expected to provide benefits for longer than 12 months. So think of things like machinery, buildings, land. These things are not going to be converted into cash. They're not going to sell their machinery and their buildings in the next 12 months. They're going to remain there and they're going to continue to provide benefit for the company for over 12 months. And this also includes other things such as intangible items like intellectual property and goodwill. So all those things are non-current assets. They're going to be sticking around for a long time, for more than 12 months. Then we have liabilities. So liabilities are what the company owes and will be a cost to the company in the future. So for example, debt is a liability because the company owes money and at some point in the future, it's going to cost them when they have to pay it back. And again, liabilities are broken down into current liabilities and non-current liabilities. So current liabilities are also known as short-term liabilities. Those are liabilities or things that need to be paid within the next 12 months. So this includes short-term debt, which means that it's debt that they have to pay within the next 12 months. It's due in the next 12 months. It also includes various items such as deferred revenue or unearned revenue, which means that the company has received the money, but they haven't provided the product or service yet. So it would be, for example, if someone paid for their cruise ship, so they paid for a holiday in advance, the company has received the money from the customer, but they haven't provided the service yet. They haven't provided the holiday yet. And again, of course, they have non-current liabilities, which is just liabilities that are due beyond 12 months. So this is long-term debt, and deferred revenues can also be in there as well. And lastly, of course, we have owner's equity, also known as shareholders' equity. And this is the other way in which assets can be funded. So remember how I said that you can either take on debt or the owners can pay for it. We're talking about the owners here, the other way in which assets are funded. And the main item under shareholders' equity, as you can see here, is retained earnings. Now, I made a video talking about retained earnings if you want to check that out. But essentially, retained earnings is any profit that has not been distributed to the owners. So some companies decide to pay a dividend. Any money that they don't pay out as a dividend stays here as retained earnings. And retained earnings is just money kept in the business, and it's going to be used to buy assets which invest in the future of the company. Now, in terms of investment analysis, what we're looking for on the balance sheet, the main thing that we're looking for is equity. So we're looking at how equity is growing over time, and similarly to the revenue and the EPS on the income statement, we're looking for equity to be growing at 10% or more per year for the past 10 years. And of course, that we want that growth rate to be growing over time. So if we have a look at Apple, we can see I've got equity here. Over the long term, it's been 22% per year, which is excellent. But again, same as every other item on here, it's been decreasing over time. And recently, it's been really poor, which means that they're not growing the core value of the business as fast as they once did. And the reason we look at this is because over the long term, a company's stock price will move in the same direction as equity. So if a company can consistently grow equity over the long term, that company will do very well as an investment, provided that it's bought at the right price. You don't want to overpay for a company. If a company has growing equity over time, then it indicates that they are retaining their profits and using them to buy good assets or using it to pay down debt, both of which increase owners' earnings, both of which increase owners' equity. The second thing we want to make sure is that the company has enough short-term assets to cover their short-term debt obligations. And to do this, we're going to use a current ratio, and this basically takes the current assets. So up here, we've got current assets, and it divides it by the current liabilities, and that will give us a current ratio. And we want this current ratio to be above 2 for Apple as of 2017. So this isn't updated yet, but it was at 1.3, so it's a little bit low. And we like to see that above 2 so that we know that they have enough sort of cash and assets that are going to be converted into cash, enough of that to cover their debts that are due in the next 12 months. And then the last thing that we're looking for here is that we want to ensure that the company's overall debt isn't too high. And to do this, we can have a look at debt divided by equity. And basically, we're looking for a 0.5 ratio here. And as of 2017, they had a debt to equity ratio of 1.8. So they have much higher levels of debt than I personally like to see in a company. And the reason for that is just that if a company has no debt, there's no risk that they can default. So, I mean, that's basically it. There's always a risk of default if they have debt. The higher amount of debt that they have, the higher risk of default. So I just like to see low levels of debt in a company, and considering there are tons of companies out there, there's no need to rush into a company that has high levels of debt. So that's all we've got for episode 2. I hope that helped you sort of clarify what the balance sheet is and what are the main components that we're looking at when investing in businesses. If you did enjoy the video, make sure you leave a like on the video and let me know your thoughts down in the comment section below. But for now, guys, I'll see you in the next episode.